Nice work. Each week we have a chat to Leith Van Onselen, macrobusiness.com.au, Chief Economist at the MB Fund at MB Super, and he's on the line. Morning, Leith. Hope you're well.
Yeah, good, thanks, Luke. How about yourself?
Very well indeed, mate. Very well indeed. Now, all the talk this week, or nearly all the talk, has been around this proposal which was there during the election and before the election, but has become a thing post the election, I guess because the government has such a big majority, this unrealised profits tax on super. Maybe a quick 101 on how this would work and why it's good or bad, if you wouldn't mind.
Yeah, sure. So what Labor's proposing is if you have a superannuation balance of $3 million or more, that any paper profits, I call them paper profits because they're unrealised. They're basically if you've got say a $3 million share portfolio and your shares go up 10% over the year, but you don't actually sell any of those shares, what they want to do is basically tax you on that 10% increase. So if your shares go up by $300,000, they'll tax you on that $300,000 increase. Now, as far as I'm aware, this is something that we've never seen before in our tax system, whereby governments are starting to tax unrealised gains. And, it does raise a lot of issues because what happens if, obviously financial markets are very volatile, so they go up and down, and we saw that after, the Trump administration announced their tariffs that share markets tanked. Well, what happens on the downside? If share markets fall, are they going to send you a check? What happens if you hold non-financial assets in your portfolio? So, unlisted assets like residential property. How do you value that? Anyone who's tried to sell your house, you don't know what you're going to get for your house until you sell it, right? And often it's greatly below or under what you thought you were going to get. But how are they going to tax unrealised gains in property held in superannuation accounts or anything like that? It's a very ridiculous policy because it's something we haven't seen in our tax system before, and there are some other problems with it. They want to basically have this $3 million balance unindexed. So what that means is that as people's wages and everything go up with inflation, that $3 million obviously falls over time in real terms. And, for example, if we had 3% inflation for the next, basically in 23 years or 25 years, that $3 million balance would be the equivalent of $1.5 million, right? Because, assuming everyone's wage goes up with inflation, using the rule of 72, which is how long it takes for money to double, it's about 25 years for money to double over that time. So you're not actually any better off, just that the price of everything's gone up. It's doubled over 25 years. And under this policy, if they don't index the $3 million limit, well, that $3 million in 25 years becomes $1.5 million, which means it's going to be capturing a hell of a lot of people in the net, which is kind of ridiculous. And for good reason, pretty much everyone opposes this. So we've seen industry superannuation funds, self-managed funds, investors, business leaders, even ex-trade unionists have all said Labor should scrap this. Now, obviously, some of those parties are vested interests, right? So superannuation funds. But for me, the most important, salvo came from former RBA Governor Phil Lowe, who said that it's bad policy and that we should be exploring other ways to make the superannuation system more equitable and sustainable. And the biggest pushback came from Ken Henry, who actually, former Treasury Secretary. He led the Henry Tax Review in 2010, which basically, proposed a fundamental reform of Australia's tax system. And he said that he understands why the government wants to make the system more equitable, but there were loads of options outlined in its review 15 years ago, which would make it more equitable rather than going down this road. And he actually opposes the unrealised capital gains because for all the reasons I've just said. And look, the government is right to a degree to crack down on superannuation concessions. They are, regressive, so they give the most benefit to higher income earners. And the reason for that is they apply a 15% flat tax on contributions. What that means is if you're a higher income earner on a higher marginal tax rate, you get a bigger tax concession than someone who's on a lower marginal tax rate. And, the superannuation concessions do cost the budget a hell of a lot of money. So the most recent budget estimates were it costs around $60 billion per year, and that's mostly in income taxes foregone.
Yes.
Now, and the overwhelming bulk of these concessions go to higher income earners. So 91% of the benefit of these concessions goes to people on above median incomes, and 32%, so about a third, goes to the very top 10% of income earners. So yes, it is a bit inequitable, and long-term projections from the Australian Treasury show that superannuation concessions are going to cost the federal budget more than the age pension by 2050. So it is an enormous drain, and if we did lower these concessions, we could do other things like lower income taxes across the board, for example, or lower marginal tax rates, which is a good thing. But according to Ken Henry, a better solution in the Henry Tax Review is instead of, to make it more sustainable, instead of giving a 15% flat tax, a better idea would be to give a 15% rebate, a flat rebate. So, for example, if you're earning $220,000 a year and you're on a marginal tax rate of 47%, under the current arrangements, you pay 15% on your contribution, which means you get a tax break of 32%. And if you're someone who's only on 30 grand, every dollar you put into super, you're on a marginal tax rate 18%. Every dollar you put into super, because of the 15% flat tax, you're only getting a 3% concession.
Yeah.
So a smarter thing to do would be to apply the marginal tax rate minus 15%. That way everyone gets the same concession. It'd become progressive. So basically the superannuation would be taxed along. The higher you earn, the more tax you pay, but you'd still get a benefit. And that is a simple solution to this problem. It would make it more sustainable. It would cost the budget less to save billions in dollars in tax foregone. It would benefit people lower down the income scale so they can save super more quickly. And it would relieve future pressure on the age pension because more of those low income people would be less likely to go on the age pension, whereas higher income people were never going to go on it anyway. And that is a simple thing they could do if they want to, make it more sustainable and save money, rather than this unrealised capital gains tax, which is just, quite frankly, ridiculous, moronic policy that is really unworkable, to be quite frank. And without indexation, it's going to capture a hell of a lot of people very quickly as wages go up with inflation.
Yeah. It just doesn't seem that the idea that you'd pay tax on something you haven't realised is bizarre. And as you say, what in the years where things go the other direction, do you get a loss to carry forward? No wonder so many people are against it. Now, the government housing forecasts, again, and I remember seeing this through the week, this apartment developer, Tim Gurner, warning that our rental crisis will last another 15 years due to lack of supply. Now, you hear government talk about, we're going to build all these new dwellings. We're going to make it easier for developers to get in there and build extra homes. But all the available evidence, it just points that we'll end up going in the other direction, doesn't it?
Yeah, it does. So yes, I mentioned Tim Gurner last week. Now, hilariously, the federal government's own advisor on housing, which is the National Housing Supply and Affordability Council. Again, this is their own advisor, which they've set up.
Yeah.
They released their 2025 State of the Housing System report. It came out this week. And what they said is that they expect the Albanese government to miss its 1.2 million housing target over the next 5 years by 262,000 dwellings.
Right.
So even the federal government's own advisory council says there's no hope in hell that we're going to meet the target. And what they also said is because of this high immigration that the federal government's choosing to continue to run, that housing supply, that new housing supply is going to be below population demand for every single year over the next 5 years. And at the current housing undersupply that we've already got, which Shane Oliver estimates could be up to 300,000. And surprisingly, this report doesn't actually give you a number of where we're at now. But what they said is that we're going to have a cumulative addition to that shortage of 79,000 homes. So we're going to have demand because of immigration and population growth exceeding supply over the next 5 years by 79,000. Now, hilariously, Luke, this is the thing I keep going on about. The only solution to this that will actually work is to cut immigration, because you've got to import less people into your housing market every year to keep up, so that supply can keep up. It's pretty logical stuff, right?
Well, it's mathematics, Leith, isn't it?
Yeah,
it's purely mathematics. Do the mathematics. It's not hard.
Yeah, and this is the hilarious thing. So in the back of the report, it's hundreds of pages. The National Housing Supply and Affordability Council, again, this is the federal government's own advisory council. They said that obviously with this ongoing strong immigration and undersupply, we're going to have a worsening rentals crisis. It's going to continue. But they had some sensitivity analysis whereby they said that if population growth was only 15% less than what they forecast, and their forecasts are based on the federal government's official forecasts, but if it was just 15% less, instead of having a shortage of 79,000 homes over the next 5 years, we'd actually have a surplus of 40,000 homes, right? What does this tell you, Luke? It tells you that the solution here is to slow immigration.
Yeah.
And the federal government's own advisory council says that if we have this is just 15% less population growth over the forecast period, the next 5 years, we'll have a surplus of 40,000 homes. So we'll build 40,000 more homes than are needed by population growth. Whereas under the baseline forecast, which is the federal government's, basically the budget's current forecast, we're going to have a 79,000 shortage because population demand is going to run ahead of supply for the next 5 years. So it's written here in black and white that the primary solution to this housing shortage is to cut net overseas migration to a level that's below the nation's capacity to build housing infrastructure. I say this almost every week. It is so logical, and yet the federal government and all the economists who keep banging on about the supply side, claim it's a supply issue, continue to ignore the obvious, and it's here in black and white in the federal government's own advisory council.
Extraordinary. Macrobusiness.com.au. Outstanding as always, my friend. Take care. I'll talk to you next weekend.
Yeah, thanks, Luke.
Thank you, Leith Van Onsen. I mean, as I said to Leith, and he's been saying forever, it's purely the mathematics. I just have to reinforce the point he made. The National Housing Supply and Affordability Council, the federal government's own body, has said there'll be a shortage of 79,000 homes over the next 5 years. That shortage of 79,000 can be a surplus of 40,000 if population growth is 15% less than forecast. It wouldn't take much more than the intelligence of a porcupine to think, oh, well, let's do that.
Aussie Crypto Exchange